Hi, Kwanza. Before I go into the specifics about what I've come up with regarding our recent conversation, if you haven't already done so, please go to my website, mrdavco.com. And once you're there, click on the Insurance Pension Plan. And under what will come up are a couple of videos. One discusses the Index Universal Life as a plan in which to you can use towards retirement to supplement your retirement, as I discussed with you, and also the 457B time bomb. This goes into some specifics as to what is happening there and what could happen, and more in that regard. Let me go into now. But please take a look at these two videos before you look at. Hopefully you've looked up. Well, let me back up a minute. I'm going to send an email letting you know that this video is ready, but I'm also going to advise you that you look at this site and the insurance pension plan page on my site before you look at this video, and hopefully you've done that. Okay? Sorry for the confusion there. Now I'm going to touch on a few things here in support of the video, hopefully that you've already watched before watching this, and that is that after the market crash of 2007 and 2008, CBS, 60 Minutes, and Time Magazine dug deep into the problems and inherent risks that the qualified plans have. They came up with four primary risks: market losses, high management fees, future tax rate increases, and the longevity risk, outliving your savings. During their investigations, they fortunately discovered that there was an alternative to the 401k or the 457b that had none of the four primary risks associated with those types of plans. Now, as you can see, from the early 1900s to today, the market consistently goes up and goes down and has experienced many devastating market crashes. The average loss is over 47%, and those crashes take place about every 11 years. What you may not know is that the 401k only came into being in the mid-1980s, while 457s began during the late 1970s. And in fact, San Francisco's 457B plan was adopted in 1979. So as you see, from 1984 all the way to the year 2000, you didn't have to be a smart investor to win on Wall Street. You simply had to have money in the market. And everybody thought they were going to retire with plenty of money back then. But then came the devastating crash of 2000, and then again in the year 2007. So the question is, not will the market crash again, but when? And will you have enough years before you retire to recover from your losses? That is the main consideration here. Now, with the 457 deferred comp account, there are two things you have no control over. The first thing is management fees. That's entirely up to where you have your money located, and whatever the management decides they can charge and what they need to charge. The second is taxes. Who knows what taxes will look like in the future with this latest Trump administration tax proposal or tax implementation, excuse me. It's going to cause trillions of dollars of loss of income, in which the only way to address it is taxes. It's for the super rich and not for the working class or the upper working class individuals at all in this country. So taxes is something else you have no control over, and more importantly, you have no idea what they'll look like in the future. So here's a simple explanation of how increasing taxes will affect the amount of money that you'll have left to retire on. Now imagine this bill, and imagine if you would continue to put more and more and more money into a deferred comp account, okay? So imagine this bill at the top was your 457 retirement money. The red portion is the tax deferred portion that belongs to the United States government. The large part on the left is the money that you have saved for your retirement. Now, if taxes went up, as you can see below, the government ended up taking more of the money that you had saved to retire on by just raising taxes. That's the danger of the tax time bomb that you'll experience just when you need your money the most. And another risk factor is outliving your income. As a matter of fact, the AARP did a survey and 61% said they feared running out of money more than they feared dying. In addition, the editor of Time magazine was being interviewed on MSNBC Morning Joe, and he was exposing all the problems associated with qualified plans like the 457 deferred comp. And the moderators asked him if we shouldn't be putting our money into a 401k or 457 or any other qualified plans, where should we put it? And his response was to put your money into an insurance plan that guarantees a pension. This plan not only guarantees you a lifetime pension, but it can provide you with a tax-free income that will last until the day that you die and guarantee that you will never lose another penny when the market crashes again. So, the reason why this program is so great, and the numbers that I'm going to go over with you to point out just how they can work as per the figures that you gave me the other day, is that you'll be getting a tax-free retirement savings and a tax-free death benefit for your family if you were to pass away prematurely. And it's all rolled into one simple plan. Unlike your 457 deferred comp, you can take a tax-free income at any time without having a mandatory repayment. You can take income now while you're working to pay for your child's college, if that were a consideration. Pay off a car loan, or you can take an income from it when you retire. And you can get all of this for the same amount of money you would be putting into your 457 or other qualified plan without all of these benefits. Well, in telling you that when the 457 came into effect in City and County of San Francisco, in the mid-1980s, Congress also passed 3 congressional acts called TEFRA, DEFRA, and TAMRA. They stand for the Tax Equity and Fiscal Responsibility Act of 1982, the Deficit Reduction Act of 1984, and the Technical and Miscellaneous Revenue Act of 1988. Now, these 3 congressional acts are the bones upon which this tax-free program was constructed. It's also tax-free under Internal Revenue Code 7702 and 7702A. So why haven't you heard of it before? Well, because between 1984 and 2000, the market was going up year after year, and anybody that was in the market was making a lot of money, and they simply had no interest in exploring anything else. So everybody forgot about the fact that the market would eventually crash. Plus the fact that working class individuals still to this day don't have much access to CPAs or consultants who are on the who are paid to provide them with ongoing services in this regard. So let me quickly explain how and why this program, this Index Universal Life program, will never lose any money from a market crash. If the market goes up 10, 20, 30, or even 40%, this program has a cap that will only allow you to capture up to about 12% of the market. Now, most people will say that, well, I want to capture all of the gains. But by having the ability to capture all the gains, a qualified plan exposes your savings account to 100% of all market losses. So by limiting the upside gain, you're guaranteed a 0 loss when the market crashes. But you will match whatever the market does between the floor of 0 and whatever the upside cap is. So you share in all the gains, but you do not share in any of the losses. So when you put your money into this retirement vehicle, the largest portion is your tax-free savings, and the very smallest portion covers a tax-free death benefit that will go to your heirs when you eventually pass away. So, the majority of your money will be yours to use for retirement in the future. So let's compare the guarantees that you get with your 457 plan versus the guarantees you get with the tax-free plan. The first guaranteed of the qualified plan is that you're guaranteed that 100% of the money in your 457B is at risk of loss when the market crashes. The tax-free plan guarantees if the market crashes, you will not lose a single penny from the market crash. You're also guaranteed that when you take the money out from your qualified plan, you're guaranteed that you're going to pay taxes on every penny you take at whatever the future tax rate is. Whereas a tax-free plan guarantees that your income will be tax-free. Now, the next guarantee is that not one penny of any of the money of your qualified plan is ever locked in and is always subject to market loss. Whereas a tax-free plan guarantees that your earnings are locked in on an annual basis. And finally, if you have anything left in your 457 plan upon your death, the money goes to your heirs, is guaranteed to be taxable when they take money out of the inheritance. Now, with the tax-free plan, the money goes to your heirs. That goes to your heirs, is guaranteed to be tax-free. So now let's take a look at the illustration I put together for you. So this illustration is the Universal Index Universal Life Policy illustration is with North America Company, and the amount based upon what the specific amount you were telling me that you would be put into a budget to create this plan is $1,166 a month. With that, based on your age and the fact that you don't smoke, your initial death benefit would be $259,084. Now, the index selection I would recommend would be the S&P 500, which is the rankings of the top 500 corporations in the United States on their performances. It's annual, point to point, just means that from the date that the policy is issued to the anniversary of that policy is from one point to the other. So that means just policy anniversary. And 100% of the funds would be going into this index. The minimum cap rate is 2%, and the current index cap rate is maxed at 11%. Now, this particular index, the minimum is showing 4.17% return, the average of 6.54%, and the maximum is shown as 8.27%. So the figures I'm going to show you is based on the average. Now, this is a chart showing the S&P 500, what it's averaged out, or what has happened with it over the past 20 years, starting in 1998, where you saw a gain of 26.7%, and of course 11% cap. All right. So, but then year 2000, it had a loss of 12.7%. So again, with the zero floor, a person having money in this account would not have sustained any losses whatsoever. And again, a loss in 2001, big time loss in 2002 and 2003. 2002, and so no losses would have been experienced, and whereby in 2003 it picks up again, and so do the experiences here. So all gains and no losses, even though there are and have been losses historically with the S&P 500. So the average out of this 20-year period was 7% on this. Okay, so that's the gives you an idea of how the S&P 500 works and has worked historically over the past 20 years. And you can see there were substantial losses involved during that period of time. So what could this all mean to you? Well, if you're putting in that amount each month, all right, which comes out to $13,992 a year, we know what the death benefit is, and based on the average, the middle of the road average of 6.54%, then you see an account value that goes up each year, and there's a death benefit that also increases every year. And so, as an example, if you were to continue putting in that amount without any changes all the way to your age 62, then you would have put in a total of $195,888. Your amount in the fund at that time, based on the 6.54%, would be $255,982. At age 62, you start making withdrawals tax-free of $16,234 a year for the rest of your life. Now, I know you had spoke about age 60, but the reason why I'm showing age 62 is for this reason. You need to ask yourself this question. Let's say at age 60, you're retired, all right? And then someone comes to you and says, hey, if you work for my company doing the same thing you did for SFMTA for 2 years, I will guarantee you an income of $800 a month for the rest of your life. Would you consider doing that? Because that's exactly what you would be doing here by working another 2 years to age 62 to have a total of 28 years versus 26 years versus having 54.6% of your income versus 64%. And based on $100,000 of income, $4,550 a month versus $5,333 a month. So, of course, you will have a better idea of where you're at that, in your late 50s at that point in your life. But that's a big time consideration, so I'm just going to, look to the future, and that's a great thing about the index universal life is it's flexible in design that you could stretch it out to, if things change in your life, and so the figures would look even more better for you if you're putting more time in, dollars and time into it. So let's say you've lived a long and fruitful life after retirement, and you finally left the planet at age 93. Okay, still the amount remains the same. You've put in $195,888, but you've pulled out over $500,000 tax-free from this account. And by leaving the planet when you did, you still leave behind for your daughters, your family, a death benefit of over $500,000, because as I mentioned previously, the death benefit continues to increase. So for yourself, you've lived a long life, you've been able to pull out over $500,000 over an investment of this amount, tax-free, and when you leave the planet, you leave behind something more than this great memories for your family. You leave behind this amount of money from this program as well. So, like I mentioned earlier in this recording, you're establishing no risk. You only share in the gains up to a cap. You have addressed the taxable situation. This is tax-free income. It's tax-free income in which you can never outlive, and there's a tax-free benefit to leave behind when you finally leave the planet as well. So that's it in summation. And so let's talk about this some more after you've watched this. And thanks for watching this.